welcome to today's deep dive. If you look back at 2022, SoFi was, well, it looked like a lot of other high-growth tech platforms at the time.
Oh, absolutely. They were just burning through cash.
Right, burning cash, taking these really substantial losses, and just trying to figure out how to survive what was shaping up to be a pretty brutal macroeconomic shift.
Yeah, interest rates were starting to move, and it was a tough spot for everyone.
Exactly. But if you fast forward to the single source we are focusing on today, which is their Q1 2026 financial performance report, the picture is almost unrecognizable.
It's night and day, honestly.
I mean, we're looking at a business that is sitting on over $40 billion in deposits, and they're minting nearly $1 billion in pure profit. So our mission today is to really decode this.
Right, to see how they actually did it.
Yeah, to figure out the exact blueprint of how they pulled off one of the hardest pivots in finance, transforming from just a simple lending platform into this massive, highly profitable digital financial ecosystem.
It really is one of the most aggressive structural shifts we've seen in the sector lately.
And just to set the table, when we say fintech, we're talking about the intersection of finance and technology, right?
Exactly. Using mobile apps, using AI, just completely optimizing efficiency compared to old school banking.
Right. And they didn't just survive the interest rate volatility of the last few years. They actually, well, they used that environment to rewire their entire balance sheet.
Which is why this Q1 report is such a crucial barometer for the entire digital finance sector in 2026. I mean, it tests the core thesis of whether modern digital-first banking models can actually achieve sustainable long-term leverage.
And that's exactly why you, the listener, should care about this, even if you aren't an accountant.
Right.
Because whether you are actively investing, or maybe you work in the tech sector, or honestly, even if you're just looking at your own bank app and wondering who actually holds the power with your money in this shifting rate environment, this data is essential.
Oh, 100%. The legacy banking models are practically being forced to adapt to the standard that this kind of data represents.
Okay, so let's unpack this.
Yeah.
Because the scale of the user growth alone, it really requires a double take.
It's massive.
Yeah. By the first quarter of 2026, SoFi is projecting roughly 14.7 million members.
Wow.
And that represents a 38% CAGR, or compound annual growth rate, from back in 2022.
Right, and their year-over-year growth, or YOY, has consistently stayed right in that mid-30% range.
But, the metric that really caught my eye here isn't just the member count. It's the product count.
You're talking about the 22 million products being used.
Exactly. Over 22 million products. That is a 37% compound annual growth rate. And it tells me that the initial user acquisition is just the tip of the spear.
Yeah, they aren't just one-and-done users.
Right. People aren't just downloading the app to, refinance a student loan and then deleting it off their phone.
Yeah.
They are staying, and they are moving their entire financial lives over to the platform.
And that cross-selling strategy, that product-to-member ratio, is really the whole ballgame for them. It's the mechanism that drives all this profitability.
How so?
Well, think about it. If you spend marketing dollars to acquire a new customer for, say, a personal loan, that acquisition cost is pretty steep.
Oh, sure. Ads are expensive.
Right. But if that exact same customer then decides to open a checking account and then eventually sets up an investment portfolio, you are monetizing that single initial marketing spend 3 or 4 times over.
I see. And the switching costs for the consumer just become too high.
Exactly.
I mean, once your direct deposit, your mortgage, and your stock trading account are all in one seamless interface, you aren't going to leave just because some legacy bank down the street offers a slightly better promotional rate on a CD.
And that deep, deep integration translates directly into the revenue leap we are seeing in this report.
Let's talk about that revenue leap, actually.
Yeah, so if you look at their adjusted net revenue, and just to clarify, this excludes one-time accounting items, so you can see the core business operations. Clearly, it jumped from $1.5 billion back in 2022 to a guidance of over $4.6 billion in 2026.
Wow.
Yeah, that is a 41% year-over-year growth.
And the turnaround in their bottom line follows the exact same aggressive curve, right?
Yeah.
They went from that substantial loss in 2022 to an expected $825 million in adjusted net income in 2026.
Right, it's a complete flip.
But I have to stop you here. Because I look at tech valuations all day long, and the word adjusted usually makes me deeply skeptical.
That's completely fair.
I mean, it's easy to look good on paper, right? But are they actually making real money? Because adjusted is often just an accounting magic trick that basically translates to, if you ignore all the actual cash we burned, we are highly profitable.
Right. Are we looking at a paper tiger here, or is this real liquidity? It's a really healthy skepticism, and honestly, it's a trap a lot of scaling platforms fall into, but the report addresses this specifically by breaking out cash revenue versus adjusted net revenue.
Okay, and cash revenue is what exactly?
Cash revenue is exactly what it sounds like. It's the actual liquid cash hitting their accounts. No accounting adjustments, no magic tricks.
Okay, and where does that cash figure sit for them?
Their projected cash revenue for Q1 2026 is at an annualized run rate of $4.3 billion.
Wait, really?
Yeah. And if you look at the ratio of cash revenue to adjusted net revenue, it has remained above 95% since early 2025.
Wait, so 95 cents of every single dollar they claim as adjusted revenue is actual cash flowing through the door?
Yes. It proves the earnings quality is exceptionally high. This isn't smoke and mirrors, you know? The cash generation is very real and it's heavily insulated.
That insulation is exactly what I want to dig into next because, sure, the cash is real, but the macro environment for the last few years has been anything but stable.
Oh, it's been a roller coaster.
Right. And if your core identity started out as a lender, and the cost of borrowing goes completely haywire due to Fed rate hikes, you usually take a massive hit to your margins. So how did they shield themselves from all that interest rate volatility?
The answer lies in how they totally re-engineered their revenue mix. They shifted aggressively toward what's called fee-based revenue.
Okay, break that down for us.
So fee-based revenue is income generated from things like service fees, brokerage commissions, or packaging and selling loans, rather than just sitting back and collecting loan interest over time.
Got it.
And they expanded that fee-based mix from 25% of their total revenue up to 43% by 2025.
Which brought that segment to an annualized figure of $1.5 billion by Q1 2026.
Exactly.
I mean, that is a massive structural change. It means nearly half of their income is completely detached from the day-to-day swings of interest rates.
Yeah, it creates incredible stability.
And it connects perfectly to what the report outlines as their, what do they call it, the economic lending model?
Right, the economic lending model. This is really their core engine. Because with every single loan they originate, they run a calculation.
Okay.
They can either choose to hold the loan on their own balance sheet to collect net interest income.
Which is just the spread between what the borrower pays and what SoFi pays its depositors, right?
Exactly. Or if they don't want to hold it, they can just sell that loan immediately.
They securitize it.
Yes. They pool these loans together and sell them to institutional investors for an upfront fee.
And that creates a completely capital-light scaling model.
Right. By selling the loans, they free up their balance sheet instantly. They get the cash, plus they get a fee, and then they can turn around and use that exact same capital to originate another loan tomorrow.
The velocity of their capital is just staggering. I mean, just in Q1 2026, they executed $3.8 billion in personal and home loan sales.
It's a huge volume.
But the detail that really jumped off the page for me was the pricing on those sales.
Yeah.
They executed those sales at a 106.5% execution rate compared to fair market value.
Yeah, that premium is key.
Right. That means institutional investors are willingly paying a 6.5% premium above the estimated market value just to buy these loan portfolios. But why? Why on earth would an institution overpay for a bundle of personal loans?
What's fascinating here is that to the institutional investor, it's not overpaying at all.
It's not.
No, because they are paying for a pristine turnkey yield stream. If a major institution wants exposure to high-quality consumer credit, they usually have to spend millions on their own marketing, customer acquisition, underwriting infrastructure, and servicing platforms.
Oh, I see. So SoFi has already absorbed all of that friction.
Exactly.
The investor is basically just paying a premium to skip the line and just instantly collect the yield.
Precisely. The demand from institutions is exceptionally high exactly because SoFi's own risk management and underwriting are doing all the heavy lifting for them.
Okay, but let me push back on that. It's like they are a financial matchmaker, right? So if I can choose to marry the loan and keep it for interest, or play matchmaker and sell it to an investor for a quick fee.
That's a good way to look at it.
But if they're selling billions of dollars in loans at a premium, what happens if the people who took out those loans start defaulting? Isn't there a massive risk hiding in here?
Well,
Because that entirely depends on the underlying loans being bulletproof. If the loans go bad, that institutional demand dries up overnight.
you're absolutely right to ask that.
And when I look at the sheer volume of their originations, it raises a flag for me. I mean, personal loans surged to a projected $27.5 billion.
Wow.
And a massive driver of that is borrowers refinancing high-interest credit card debt. And for context, there's roughly $1.2 trillion in outstanding credit card debt in the U.S. right now. And, refinancing just means taking a new loan to pay off an old one.
Exactly. And we also saw their student loans recover to 5.5 billion and home loans accelerated to 3.4 billion.
Right, the volume is massive across the board. So if you are suddenly holding or selling tens of billions of dollars in personal unsecured debt in a fluctuating economy, aren't you just sitting on a powder keg of default risk?
You would be if you were lending to the average consumer.
Okay.
But the demographic profile of this specific SoFi borrower is really the key to this entire ecosystem. The weighted average income of their personal loan borrower is $154,000.
Wow.
And they have an average FICO score of 745.
Okay, so here's where it gets really interesting. When you look at those numbers, SoFi isn't lending to people who are just desperate for liquidity just to keep the lights on.
Not at all.
They are targeting high earners who are actively trying to optimize their balance sheets.
It's essentially an arbitrage game for the wealthy borrower.
How do you mean?
Say you make $150,000 a year, but you racked up some expensive revolving credit card debt, maybe from a home renovation or some unexpected medical bills.
Right, life happens.
Exactly. You aren't going to default on it, but you are paying, 24% interest to some legacy bank. So SoFi steps in, refinances that debt into a personal loan at a much more favorable rate, and they scoop up an incredibly reliable, high-income customer in the process.
Basically, they are cherry-picking the absolute safest bets out of the traditional banking system, like a bouncer at an exclusive club, only letting in the absolute safest bets.
That's a perfect analogy. And the net charge-off rates completely prove that strategy out.
And net charge-offs, or NCOs, that's the actual credit losses, right? Money they actually lose to bad debt.
Yes. And those NCOs peaked for personal loans at 3.84% back in Q2 of 2024.
Okay.
But by Q1 2026, that rate had steadily improved, dropping down to 3.03%.
That's a solid drop.
And if you look at their student loan portfolio, the NCO rate is practically non-existent. It's sitting at 0.65%.
Which makes sense. I mean, high-income professionals rarely default on their student loans if they can help it. But the report also tracks the performance of these loans over time, right? What they call the vintage performance.
Yes, exactly. A vintage just tracks a specific cohort of loans that were issued during a set time period. And the data shows their underwriting is demonstrably getting tighter.
Tighter how?
Well, the Q4 2025 vintage saw a 159 basis point improvement over their 2017 benchmark.
Wow.
And by Q1 2026, that cohort improved even further, showing a 168 basis point outperformance compared to their historical models.
Meaning, the newer loans they are issuing today are performing significantly better at avoiding defaults than the loans they were issuing just a few years ago.
Exactly.
But, what happens if the economy just takes a massive, unexpected dive?
Well, they ran a life of loan stress test on the portfolio to model exactly that scenario. Out of a total unpaid principal balance, which was $29.3 billion, their cumulative net losses sit at just 4.2%.
Okay, so 4.2%.
Right. And the stress test revealed that they would need to experience a catastrophic 10% loss rate on the remaining balance just to hit an 8% life of loan loss.
Just to hit 8%.
Exactly. And to put that in perspective, a 10% default rate among a cohort of people making $154,000 a year would imply an economic collapse on par with 2008.
Oh, wow. So the balance sheet is essentially bulletproofed against standard market volatility.
Completely. So, we've established that the consumer side is firing on all cylinders.
Right.
High-income borrowers, low defaults, massive fee generation from securitization.
Right.
But to really understand the leverage this company has, we need to look beneath the app interface. We have to look at the hidden vault, the infrastructure that actually funds and powers this entire machine.
You're talking about the deposits and the B2B tech platform.
Exactly.
Because securing that official bank charter back in 2022 fundamentally altered their DNA as a company.
It changed absolutely everything about their cost of capital. Before they had that charter, they had to rely on external borrowing things like warehouse lines of credit just to fund their loan originations.
And that kind of capital is very expensive.
Very expensive. But after the charter, they began transitioning their funding base, where the bank gets its money, essentially. And by Q1 2026, they are an incredible 96% deposit funded.
Because they've amassed over $40 billion in customer deposits since 2022. And think about the mechanism of how they actually did that.
Yeah.
They didn't just open a bunch of physical branches and, hope people walked in off the street.
No, not at all.
They reduced the friction entirely. They offered highly attractive yield rates and integrated the savings account right next to the user's investment portfolio and their loan tracker,
It's
all in one place.
And because that customer capital is just sitting right there in the ecosystem, it costs SoFi almost nothing to access compared to borrowing on the open market.
Yeah.
The report actually estimates that this specific shift to deposit funding is saving them $622 million annually in expenses.
Over $500 million falling directly to the bottom line every single year just because of how they structure their capital.
Exactly.
And it drives their net interest margin, or ANIA, to an incredibly healthy 5.94%.
It really does. But, those deposits, as massive as they are, they're really only one half of the structural moat they've built.
Okay, what's the other half?
The other half is the SoFi Technology Solutions segment. This is where they operate the banking core ledger.
And just for anyone listening who isn't deep in banking infrastructure, a core ledger is basically the central nervous system of a financial institution. It's the foundational software that records every transaction, every transfer, every balance update.
Right. And SoFi didn't just build a cloud-native modern ledger for their own app. They turned around and started providing this exact digital infrastructure to enterprise clients.
Other banks.
Yep. By Q1 2026, they had 133 million tech platform accounts operating on their system.
That's insane.
And looking back at the Q4 2025 data, that segment alone generated $122 million in net revenue and $48 million in contribution profit.
Okay, I have to admit, when I first read that in the report, it seemed like a strategic misstep.
Really? How so?
Well, it's like a famous restaurant realizing its secret sauce is incredible, and instead of just, selling more burgers, they start selling vats of the sauce directly to competing restaurants down the street.
I see what you mean.
Right, like, why would you license your core technological advantage to other financial institutions? They aren't just a bank. They're selling the plumbing for other banks. But does focusing on B2B infrastructure distract from their core consumer mission? Aren't they essentially arming their own competitors?
I totally get that concern, but think of it less like a restaurant and more like Amazon Web Services.
Okay, AWS.
Yeah, Amazon built a massive internal server infrastructure because their e-commerce store needed it to survive. Then they realized the infrastructure itself was a product they could rent out.
Ah, right.
SoFi built a modern ledger to run their app, and now they are the underlying plumbing for 133 million accounts across other platforms.
Okay, that makes sense. Because legacy banks are notoriously stuck on decades-old mainframe software.
Exactly.
And the friction to upgrade that is so high that it's just easier for them to license a modern white-label solution directly from SoFi.
Precisely. It completely diversifies SoFi's revenue away from purely consumer lending and introduces this highly predictable enterprise software as a service revenue stream.
A B2B revenue stream.
Right. And from a regulatory standpoint, it creates an absolute fortress. Their CET1 risk-based capital ratio, which measures a bank's core equity capital against its risk-weighted assets, is sitting at 21.1%.
And the regulatory minimum required to be considered well-capitalized is only 7.0%, right?
Yes.
So they're operating with 3 times the required safety net.
Furthermore, their Tier 1 leverage ratio is at 17.7%, which completely blows past the 4.0% minimum. They are overcapitalized and shielded from systemic sharks in a way that pure-play consumer fintechs simply are not.
Which brings all of these individual threads perfectly together, really.
It does.
Because when you combine the explosive product adoption, the pivot to capital-light fee revenue, the strict high-income credit profile, and this massive fortress of cheap deposits and AWS-style tech infrastructure, it leads directly to their financial guidance for the full year of 2026.
And the defining theme of that FY 2026 guidance is operating leverage.
Operating leverage.
Yes, the business is finally at a scale where growth doesn't require proportional spending.
Right, meaning the revenue is growing significantly faster than the costs. As the machine gets bigger, the profit margins actively expand instead of just getting bogged down.
The projections demonstrate this clearly. They expect total revenue to grow by 30%. But because of that operating leverage, their adjusted EBITDA is targeted to increase by 52%, reaching $1.6 billion.
Wow. And the bottom line is even more aggressive, right? Net income is forecasted to surge by 72%.
Yep. If you look at the per share value, Diluted EPS, or earnings per share, is rising by 54% to 60 cents.
Nice.
Their tangible book value, which is the hard, measurable net worth of the company's assets, is surging to a projected $9.2 billion.
That's massive.
And crucially, their ROTCE, the return on tangible common equity, is improving to 8.0%.
So what does this all mean? When you step back and look at the sheer volume of data we just went through today, what is the core insight for anyone navigating this space?
Honestly, it means that the theoretical model of the all-in-one financial app actually works, provided you have the discipline to build the underlying plumbing first.
Right.
This report is proof that in modern finance, if you architect the balance sheet correctly, scale doesn't create bloat, it creates exponential efficiency. Every new deposit lowers their cost of capital. Every new enterprise client strengthens their regulatory ratios.
Yeah.
They've built a completely self-reinforcing ecosystem.
It is a remarkable evolution from where they began. But, it leaves me with one final thought, and it circles right back to that AWS-style technology segment.
Okay.
Because if SoFi continues to aggressively expand its tech platform to other enterprise clients, could we see a future where traditional legacy banks survive only by secretly white-labeling SoFi's digital infrastructure?
Wow, that's a real possibility.
Right. And if so, does the real power in the future of finance lie with the flashy consumer brand shining on your phone screen, or the unseen ledger quietly extracting a toll on every transaction beneath it?